Welcome back to the Wall Street Podcast.
Glad to be here.
Today we're doing a deep dive into a really comprehensive analysis from the Wall Street Journal. This came out Monday, September 8th, 2025.
That's right. It covers quite a bit. Fed policy, debt dynamics, global trade, lots of moving parts.
Exactly. It gives some critical viewpoints for making sense of the current economic landscape. So let's jump right in. First up, monetary policy.
Okay.
The journal leads with soft data on jobs stir hope for faster rate cuts. It looks like job growth slowed down meaningfully this summer.
Yeah, the numbers are quite striking. Fewer than 600,000 jobs added this year so far.
Which is the lowest since 2009, if you exclude the anomaly of 2020.
Right, and that weakness is directly influencing market expectations about the Fed. Traders are betting on bolder action.
You see that reflected in Treasury yields.
Definitely. The 2-year Treasury note yield, that's down to 3.506%, a 3-year low.
So the market's pricing in cuts. What are officials actually saying?
Well, the debate seems to be around consecutive quarter-point cuts through the rest of the year. The market's implying, what, a 75% chance for cuts at each of the last 3 meetings?
But there's always a but, isn't there? Inflation.
Inflation is the wild card. Absolutely. It seems kind of stalled above 3%.
Still above the Fed's 2% target.
Exactly. So while the jobs data might argue for faster cuts, that persistent inflation probably means policymakers will want to be cautious. They won't want to risk prices taking off again.
Makes sense. A delicate balance. Okay, let's pivot to debt, both corporate and consumer. The journal mentions companies binge on debt sales.
Yes, we're seeing record issuance, particularly in junk-rated debt.
So riskier companies borrowing heavily. Why now?
Falling borrowing costs are a big part of it. Plus, investors seem very keen. There's a high appetite for yield right now. Companies are locking in these lower rates.
Good for them now, perhaps, but does it build up systemic risk?
It certainly could. More leverage, especially lower-rated leverage, always increases vulnerability if, the economy takes a downturn.
And what about consumers? The report talks about America's buy now, pay later economy.
That's another area showing some stress. Serious delinquencies on credit cards and auto loans are climbing.
How high?
They're reaching levels we haven't seen since the 2008-2009 financial crisis period.
Wow, that's concerning.
It is. And what's interesting, or perhaps worrying, is that the official numbers might not even show the full picture.
How so?
Well, for one, government agencies and GSEs are buying up some distressed mortgages, which sort of masks the true delinquency rate there.
Okay.
And then there's buy now, pay later itself. A lot of those services don't report to the main credit bureaus.
Ah, I see. So people could be taking on more debt than traditional credit scores reflect.
Precisely. It creates a potential blind spot. Vulnerable consumers might overextend themselves without it showing up immediately. Add to that a rise in margin borrowing for stocks. You get a picture of rising leverage across the board.
Okay, let's move to the global picture. Trade tensions. The journal says the EU tariff truce faces risk of unraveling.
Yes, this relates to the U.S. metals tariffs. They've been expanded.
Expanded how? I thought they were just on raw steel and aluminum.
Originally, yes. But now the U.S. has applied that 50% tariff rate to derivative products as well.
Derivative products, meaning manufactured goods made from those metals.
Exactly. Things like machinery, pumps, various equipment. It affects a significant chunk, roughly 30% of EU machinery imports into the U.S.
50% tariff, that's huge. What's the impact?
The report calls it an existential crisis for some sectors in Europe. German manufacturers, for example, seem particularly hard hit.
Any specific examples?
Yeah, a company called Krone Group, a big machinery maker, apparently halted its exports to the U.S. entirely because of this.
So, immediate disruption. What about longer term?
It creates huge uncertainty. It could force a major restructuring of supply chains globally. And it's not just European companies. U.S. manufacturers who rely on specialized imported machinery will face higher costs, too. That could hit their competitiveness.
Right. Okay, so bringing this all together, what does this mean for the average person, the listener? Let's start with the Fed policy shifts.
Well, the potential for lower interest rates could mean cheaper borrowing costs for things like mortgages or loans. That's the upside.
Right.
But lower rates often signal a weaker economy is expected. So that has knock-on effects for job security, potentially for investment returns. It's a mixed bag.
And the consumer debt situation. the buy now, pay later aspect.
It offers flexibility, which people clearly value. But that hidden risk of over-indebtedness is real. It requires careful management by individuals. It's easy to lose track when it's not all on one credit report.
Plus, we saw Amazon Prime is ending free shipping sharing soon, October 1st. That might push more people towards paying for memberships or changing habits, another small pressure perhaps.
Small things add up, yeah.
So we're looking at quite a confluence of forces here. Central bank moves, corporate strategy shifts, consumer behavior changes, trade disputes. It feels like a real period of recalibration.
I think that's a good way to put it. Significant recalibration.
The big question then, for you listening, is how these interconnected trends might reshape your investment plans, your financial planning over the next year, and maybe what other risks are simmering just below the surface that we haven't even seen yet.
That's the key uncertainty going forward. Always is.